Good morning, good afternoon, good evening, depending where you are on the planet. Welcome to the Wednesday, the 14th of September, Bull versus Bear webinar. Steve Marley on the call for trade day. Welcome, everyone. We're going to go through our usual regular run through in here today. Calendar, what we've had, what we've got going on, what we've got coming up. Articles from the major news wires and the charts. I'm going to dive straight in here today, a little time constrained in here today. But, I mean, what is there more to say than US CPI was really high, right? So numbers came in way above expectations, saw an immediate collapse in risky assets. Stocks got pummeled on the downside. The dollar surged and cryptocurrencies got hit as well. And we also saw a sell-off in risky currencies more than anywhere else. So, for example, the risk currencies, the Australian dollar, New Zealand dollar were down about 2% against the US dollar. So that's also US dollar strength, but also those risk currencies bearing the brunt amongst the majors. And we also saw what else would you see? What do we see in here? And then expectations of interest rate hikes climbing as well in here. So that was a significant move. You did see a push lower in US Treasury bond prices. That is higher yields. However, not exactly like the aggressive moves that we saw on the risky assets. So, surprising that we went to higher yields, right? There's an anticipation of a more hawkish Fed. There's concerns around inflation, but not as aggressive move as we saw elsewhere. And I think that's kind of quite interesting to say that. And we're going to talk about the US mortgage rates actually went to their highest levels since, when is it, 2008, I think? 2008. But yeah, I mean, I think it's quite interesting that the treasury market, the interest rate market, yes, it reacted, but not as aggressively as we saw elsewhere, particularly with the stocks. Stocks worst down day since June 2020 for US averages. NASDAQ 5%, massive down day. And treasuries, the interest rate market telling us they're not as concerned, right? Okay, we'll look at the Fed tool in a minute, and it's going to show us, a more hawkish Fed, but not a much more aggressively more hawkish Fed. So it's going to be interesting to see. Now, the Fed speakers are on there. This was something we pointed out at the beginning of the week. They're on their blackout period. So we're not going to get any reaction to this. So the first reaction we're going to get is from the meeting next week, next Wednesday. So it's going to be interesting that we're in a bit of no man's land at the moment. We have had slight bounces overnight on the riskier assets, slight corrections in here. But Australian dollars slid low, but the euro and the pound have rebounded against the dollar. The Australian dollar's gone lower, though the risky currencies are still underperforming. So Aussie dollar's still down, New Zealand dollar's still down, but equities have had a slight bounce, but we're talking slight given the extent of the moves. Right, let's just take a look at, for what it's worth, which is not much, what we've got coming up today and what we have. I mean, we've had some UK inflation data in here, actually below expectations, the UK. So the UK actually beat expectations. We're looking for 0.6, and 10.2, came in at 0.5 and 9.9. So the UK coming in under expectations. Going into today, we've got PPI. Now, PPI very much the poor cousin of CPI, so not expecting that to really impact markets. If you're trading oil, obviously we have the crude oil inventories data, 10:30 Eastern time today. It's a focus there if you're trading oil. So a question from Clinton: for future CPIs, to help us trade them, how large a difference is big in that measure? +1 versus -1, I said, didn't seem big to me, which had me surprised by the size of the job, even starting at overbought levels. Yeah, well, I think it's not just that number there. The fact that there's a couple of things going on here. So it's a good question, Clinton, right? I think a few things going on here. One was, it wasn't just the -1.1 on the headline, right? You had, 8.1, 8.3 also on the year on year. You also had, this was a big move in here, the core. Right, this is a real concern. Remember, the core is X. So what the core is X food and energy, right? So that should be, given that we've got, food and energy prices have been dropping to an extent, not rising as quickly. This one is a real concern because it's showing now. That's showing that broader prices in here, right? broader prices, so X measures X food and energy, excluding food and energy, right? So this is saying that broader price measures are continuing to rise. You were expecting a 0.3, 0.6. Now it only seems 0.3, but it's double what we were expecting, right? So that's a real concern, and it jolted and remember what we were looking for is for all these numbers. The other thing, I think I do get your question, right? It didn't seem to be such a big miss, right? But I think another thing is that the market was really looking to have seen peak inflation, to have seen all these numbers rolling lower. Remember, we were 8.5 on the headline number on the year on year, right? And we had a flat reading previously on the previous, and then we go down to and then we drop to anticipating at 8.1. It comes in at 8.3, so it's nearly going back up to the peak, right? We also had a flat expected at -1. It comes in, it goes back up again, having been flat previously. So it felt like it had turned. If it hasn't turned, then maybe there's further. It then puts all the anticipation. So what you're building into this is not just the fact that this number was up, then is the next number going to be up? Is the one after that going to be up? That's what was also built into this. Plus, I think in here, Clinton, it's not just that. I think what I was saying about treasuries is important as well. I think, some markets didn't react. This is about positioning. So markets get moved more exaggerated, and I think there was a real kind of, and definitely from my side as well, an anticipation that we'd seen peak inflation, an anticipation that these rebounds, if I go and jump to the chart, that the rebound that we'd dipped in here, we'd sold off from August, right? And then we'd turned in the last 3 or 4 days, and that then this whole recovery, we'd turned ahead of the lows back here from June, right? And then the market was going to then push back up to the August peaks, and we were going to be back up in here going into September and Q4. And then we completely said, well, no, that's not the case now. And there's a lot of call now for the June lows to be retested. Personally, I don't think that's going to happen. I still don't think that's going to happen. It's a significant trend line in here. You see that I've got in here this trend line. The market's played with this trend line, and we're bound right on this trend line again. Okay, this is on the S&P. So I'm going to actually redraw that so it actually snaps exactly. So, but I'm going to come back to this, obviously. Let me extend that out. It's really important. Look, so if actually I haven't quite snapped it to that low there. There it is, snapped. Oh, no, it's not. There we go. So look, flirted with it here. We're sitting right above it now. Yeah, but I think what is the positioning? You had 4 straight up days, like bum, 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 bum last week. Got a lot of maybe fast money longs in here. Okay, we said yesterday the bit that the long-term money, the real money, is kind of still underweight. So they're sidelined at the moment. And then, I just think it was run for the hills yesterday. So I think it was about positioning a lot of these longs, and when we got the initial jolt down and we were like 2.5/3% down on equities on the NASDAQ. I looked at it. I kind of advise a fund, and they said to me, "What do you think?" And I said, "You know what? I think we'll rebound from these levels before the close. I don't think we're going to be up on the close, but we were 2.5% down. I said I don't think we'll be down as much as 2.5% by the close." And that couldn't have been more wrong, right? We're not 5% down, kind of stuff. So it went another 2.5%, 2%. So I think there was a lot about positioning going on in here. So I think it was an exaggerated move in here. So on those numbers, I would agree with you on that miss. That doesn't seem that big on this miss here. But I think you have to take it into the context of there's a big expectation of a peak, and there's real worries that the Fed are going to get uber super hawkish in here, so it's from where we've come, and then real concerns that these numbers then could be going back up to this headline number here, which had dropped from 8.5 through 8.1. If we go and look at the chart, they show you the chart in here, right? So we peaked up here. Actually, we peaked 2 months ago. Sorry, it wasn't even 8.5. It was peaking at 9.1, and then we hit 8.3. And then and then down here it's ticked back up again from the forecast. Sorry, 9.1, 8.5, and then 8.1. So even though it's continuing to decline, at 8.3, there's a real threat that we're going back up, to these peaks. That's what the concern is. So the peak's still in, but are we going to drop any further? Are we going to just stay here? That will be. It wouldn't be great if we just leveled out around 8%, right? So that's all part of where the concerns and where the more exaggerated came from yesterday, I think. Okay, hope that answers the question. 5 things to start your day. Let's just run through this. So Biden downplayed the slump in stocks after the data. Unemployment stays low. Yep. But we did say, I've got an article on this. So Treasury Secretary Summers called for the Fed to raise rates by 100 next week, right? So the Treasury Secretary is looking for a 100-point rate hike, where Double Line Capital's Jeffrey Gundlach remarked that a 25 basis point move will suffice. That's just not going to happen, right? We're going to look at the Fed tool. Here we are now. This wasn't even here, remember? Yeah, we had a block over this side. So this is now the 75. This is the 100. There's now 38% chance of 100 at the next meeting. And if we go further out now, November. So if we look here, we're looking at, going forward into November, we now got, 375, 400 into November. And then we've got now chances of 400 up to 425, 450 going into the end of the year. And then 425, 450 becomes the peak now. And then if we go right the way out, I can go right the way out to July, I think. 425, 450 is still the peak. So basically right through to next summer, we're looking at the peak at 425, 450 and no chance of a cut. Remember, it was only 2 months ago or 6 weeks ago that we were looking for cuts to be coming in March through May. And now we've got, not only a higher peak at 425, 450, I think that we were looking at the peak at 375, 400, or maybe even below. Now we've got a much higher peak and then no cuts coming, next year, or into the middle of next year anyway. So and there's the article. Where is it? Gundlach. Yeah. So look, Gundlach urges Fed to slow rate hikes. But big deal. Say what you want, right? But Summers in here. That's a real worry when the Treasury Secretary is calling for the Fed to be even more hawkish. Let's go through here. So U.S. aid package to Ukraine. European Commission getting really hard on the energy crisis, talking about capping revenues and taxing the energy companies and stocks. Stocks recover. I wouldn't say that. A semblance of calm returns. Basically, they stopped going down. Right. That's all we're seeing. So I don't think I wouldn't call that a recovery at all. Let's just run through some headlines. Wall Street tumbles to biggest loss in 2 years, biggest down day since June 2020. Stocks rout eases. Yeah, I think that's a better way of putting it. It's eases. Trader assess policy outlook. US index futures rally after slumps were slightly up. European stocks obviously have continued lower because we went lower after they closed. Remember, they closed earlier than the US markets, and the US markets pretty much went lower right into the bell last night. Okay. Treasury yields continue to go higher, but the dollar has actually dipped back lower, having surged higher. Futures rebound, covered that. We covered Gundlach and Summers. So US mortgage rates. So even though we're only kind of edging up on 10-year yields, mortgage rates above 6%. Obviously, that has real economy issues. I'll just share this. I don't know if you guys look at this one, but I'll put it in the chat. So there we go. But this is basically the 5 things to start your day version from Reuters. So terminal diagnosis. Setline says it all really. So EU plans windfall levers on energy companies. Already mentioned that. And energy crisis pan says solidarity with Ukraine unshakable. ECB's Lane. So Lane is the chief economist at the ECB. Obviously, he's saying, it's all about higher energy prices. It's the main driver of inflation, which clearly it is. And if the EU can get that under control, then obviously that's going to be more of a positive. So these other headlines potentially, and we are seeing gas prices falling in Europe over the last week or so. European bourses continued lower in here, and they have rebounded off the lows though, but they continue lower. So if they played catch up with the further losses after the European exchanges closed. And then obviously we had a massive down day in here. So it was like 5% on Nasdaq, over nearly 4% on Dow, 4.3% on S&P. But we've had, a can't call this a rebound really. A rebound's like 1% when you've lost 4, right? A quarter of a percent is just, it's not bid offer, but it's hardly a rebound. And we've already gone through the Fed tool. Let's take a look at some charts. I mean, I've not got much to say in here, guys. In my reports, there's nothing more I can say that these are, the chart obviously sets up massively negative going into the day, right, after this down move. However, and if you look at my reports today for both NASDAQ and S&P, I'm bearish, right? You can't, as a technical analyst, when you have 1, 2, 3, 4, fairly good up days. These were like 1% days, right? And you wipe out 3 of them in one hit. It's a massive bearish outside day. We're sitting right on this trend line in the S&P. I can't write this as a technical analyst and do my job properly and be bullish, right? However, it wouldn't be a surprise to see this bounce today, right? It wouldn't be a surprise. I think you have to be very, like I said yesterday, you have to be very fluid. You can't be tied to a direction going into the day. You'd have to say this is a dead cat bounce, right? It's done nothing. You want it up here at least, kind of stuff. If I step into even a smaller chart, I'm going to go to the 5-minute. So there was the first down leg, and it held, and then we had this another big down leg. Even paused around this area, and you can see this area here. It just paused that. So on the S&P, that's around where we've got up to this morning, right? And it paused at that area, and then it failed miserably, and we're back near the lows again. So we've been notably higher than we are. The rebound from the lows, we've given back half of that. If you put a fib on this, right? Oops. If we put a fib retracement on what we've done today, right? Look, there's halfway. There's the bounce from the lows. We've given back half of it. We need to give them back the 61.8. We're sitting right on that. So I have to play this on the short side. However, don't get tied to the positions, guys, right? This could easily turn around. Particularly, I don't think you're going to see much before the cash market opens now. But on the cash market opens, right, if you get real money coming in deciding that it's not as bad as that or that, and they want to buy, this could be all the way back up here again. It could easily be back up this where the market paused. So around 4,000 to 410, 4,010. S&P could easily be back up here. I mean, I have to play it from the short side, right? And, you got a little trigger point just here on the S&P. Remember, this is the deck contract, 39.52.75 down through there. And that's just below the 61.8 of the rebound, the overnight rebound. So, down through there looks really negative again. But, if this turns around, you've got the kind of little down trend line through, say, here, sort of thing. If it gets back above these little counter trend line from today, if it gets back above here, back above, I don't know, like 39.65, 39.68 kind of area, then it kind of looks semi-positive, but I couldn't buy it right now. You're waiting for the next, I think this is a matter of sit on your hands, be calm and confident, and then look for the next move. And I don't think you'll get that till the cash market opens. So, question from Glenn, is this the kind of situation where we can anticipate 23.5 to 50% retracement yesterday, or conditions different than that kind of scenario? I think you could see it. No, I think you're right. But at the moment, it's not telling me that's going to happen, right? So if we, if I go and let me just zoom back out to like a 15-minute, where's the retracement on the whole move? It's upside down. I've done the retracement here. Let me actually put that back on again. I'll do it the other way around. I think they do it the wrong way around, and here's my personal opinion. But that's so even 23.6 is up at like just short of 4,000, like 39.96, 39.95. So we're not even got to the 23.6. Yeah, I mean, it could easily be up there, up to the 38.2. It's got to get through all that there where it paused. That's between 4,000 and 4,015. I mean, I can see it back up here, but, you sit on your hands and wait. You don't make the decision right now, is my opinion. You wait, and I think you'll get it through the cash market open. That's first 20 to 30 minutes. I think it's going to be critical to give you some kind of idea of direction. So the first 25, 30 minutes after the cash opens. And then, no surprise, we're going to say, similar on the NASDAQ in here. We've got this kind of trend line on the NASDAQ. It's not, it's already broken this trend line. See this one that comes across through here. If I draw it to like here, this one's already gone. But if you redraw the trend line, it's kind of sitting right on it now. Okay, so that's going to be important. It needs to hold the lows. If it breaks the lows, then it's going for the lows from from a week ago, and then it opens up a much bigger downside risk. So this could be the one to watch in here, and you can say, look, we've had no rebound in here. The retracement from the high from yesterday's sell-off. 23.6 is up at 12, like basically 12,300. We've got nowhere near the first retracement. And if we zoom in more, go to 5 minutes, where are we from the lows? If I go on the fib on that, you're down through the 61.8 already. You've already given up basically, over 2/3, and then if I go in and I put the 78.6% on, I wouldn't be surprised if we're no, we're not as down as far as that. That's down at that swing low there. Yeah. I mean, if it takes out this low here, and that's near the 78.6, 12,116, it looks really negative again. Yeah, but then you're watching as well. Where am I on here? I'm watching the counter trend line. I'm watching the little down. Oh, sorry. I'm watching maybe this down through here, right? We can get in, but that's a long way to go. It needs to get above that little swing there from a couple of hours ago. Actually, not a couple of hours ago, about an hour ago. Sorry, it's a 5-minute chart. So 12,165, but really ultimately up here somewhere. Like it needs to get above like 12,175 to start showing slightly positive. So I think it's very binary in here. I'm 50-50 whether it goes up or down today. But my leaning as an analyst is, I look at yesterday's price action, you have to be bearish, right? And it's sitting on this really big support. It could easily just do another 3% down day. So yeah, I think you just have to be flexible, guys. I'm going to wrap it up there. I'm going to park the commodities for today, I'm afraid, guys. I'm going to wish you all a great trading day. Stay safe out there. I'll be back with another bull versus bear webinar on Thursday tomorrow. Until then, take care. Stay safe.